I am joined by Nathan Tankus, author at the Notes on the Crises blog. Nathan is a writer of specifically specializes in monetary plumbing, monetary theory, and in particular, the Federal Reserve special facilities of March in 2020. But now, particularly, we've got a new Fed special facility, the Bank Term Funding Program. So, really welcome to get into the weeds with it all, Nathan. Nathan, welcome to Forward Guidance. Welcome. How are you doing?
Happy to be here.
I'm happy you're here, Nathan. First of all, who is the gentleman standing behind you, and what is his importance?
So that's Zoltan Pozar. Doing a little bit of cheeky thing, having him as my background. Um, and he, you know, former Fed person, senior advisor to the Treasury under Obama, and has been a long time managing director of Credit Suisse, now Credit Suisse UBS, maybe First Boston. We'll see. We'll see what names ultimately reemerge as we get more global money notes from Zoltan. But he's a kind of he's on one hand been working in the private sector for a while, but and never been an academic. But on the other hand, has written a lot of academic papers and is seen as a really important scholar on how the banking system works, in particularly shadow banking and the driving forces behind shadow banking. And he's really there's a lot before him. There was a lot of focus on the supply side, like why people were looking to issue shadow monies. But what Zoltan really put into focus is why there was a kind of need in the financial system for shadow monies. What purpose did shadow monies serve, and what the implications of shadow monies and their proliferation were on the broader financial system. And so, he's absolutely an essential person, but because of more recent goings on, has not been available as a writer, because what he would say would have material impact on the success of his institution. You can't be at a financially stressed institution writing honestly about financial stresses. And so, since he was gone, I wrote a piece called "The Night They Reread Pozar in His Absence." It's a reference to a Krugman blog post from 2009 where he says "the night they reread Minsky," which is in turn referencing an even older movie. And so I won't decided, since he isn't around to write about his kind of core themes and the core takeaways from his scholarship, which are very relevant to this crisis. I mean, this is, as I say in the piece, is a classic. If 2008 was a Minsky moment, then this is a Pozar moment. And I wanted to really highlight his intellectual contribution, since he can't do that himself.
Yeah, let's map out that framework. You say this is a post-R moment, talking about the failure of Silicon Valley Bank, a signature bank. It hinges around shadow money, uninsured deposits, and what uninsured institutional cash pools. And Nathan, I'll sort of do the easy part. You'll do the hard part. The FDIC was created during the Great Depression so we wouldn't have another cascade of bank failures. And the idea is people would would not withdraw their money because it was insured up until a limit. The problem that Pozar puts out and that you elaborate on is that basically the financial system has become so immense that there are funds that are slinging around billions, tens of billions, hundreds of billions of dollars, and the $250,000 limit isn't cutting it. So could you first start just by referring us what is shadow money and the uninsured institutional cash pools, and then we'll take it from there.
Yeah. I mean, there's different ways you could define shadow money. The definition I kind of run with is basically some sort of something that serves as like a store of value, as either can serve as payments, can serve a payments role itself, or can be converted at par into something that can make payments. So, for example, you can convert shadow money into bank deposits and then make payments with bank deposits. But what's unique about them is that they're not issued within the banking system or any other sort of kind of money franchise that you could kind of come up with. So they're issuing something that's like a bank deposit, but it's not. But it's not a chartered bank that's issuing it, or not at least the chartered bank subsidiary that is issuing it. And the importance of that is that without direct connections to the FDIC backing or the Federal Reserve directly accessing lender of last resort powers of the Federal Reserve, these are dangerous monies. They are things that are fragile. They can break apart. They are pro-cyclical in the sense that they're seen as safe when times are good, and they're not seen as safe when times are bad. And that's a huge problem, and that's exactly what you were talking about. Part of the point of bank deposit insurance was getting rid of the pro-cyclicality of money, and with shadow monies, the pro-cyclicality of money is reintroduced. And money isn't there when you really really need it to be there in terms of its ideal liquidity and other sorts of properties. Now, what Posar did, the brilliance of Posar's work, is he hammered that inherent connection between, well, why are these non-bank entities able to issue money when they don't have when they don't have the bank charter, when they don't have the money franchise, so to speak,
Or
um
FDIC insurance.
and or FDIC insurance, or any of these kind of special things that backstop the chartered bank money. And he looked at that from the demand side. Why were they these entities that were willing to hold this stuff? And he identified the core factor is, well, bank deposits themselves were were falling behind as money. They were not the great money from the point of view of these large entities. It's very weird to think, because money in the bank, like, we as households, we can't imagine having, most people, I mean, maybe some of your audience can't imagine, but most people can't imagine having more than $250,000 in a checking account. It's crazy, or even a savings account or anything. Like, you can't imagine where that would even be an issue that comes up. So you don't really think about it. FDIC insurance, good enough for you.
Right, and so just yeah, that limit is up to $250,000. So if you have $251,000 in the bank, the first $250,000 is insured. The $1,000 on top of that is not, and everything on top of that is also not. For Silicon Valley Bank, the FDIC did insure all uninsured depositors. So if Roku
Yes, and
had
we'll
billions of dollars of uninsured deposits, they were made whole.
Yeah, and we'll get to that. But the core issue that Posar was talking about is, well, these uninsured deposits, there is a risk. Now, also, frankly, especially with too big to fail, you might think, oh, you can just put it in too big to fail bank. That's not, then it's not a problem. Something they really emphasize, which kind of gets undercovered, it's often the reason that isn't satisfactory is because, come on, too big to fail, the bank is going to get bailed out, doesn't hold up to scrutiny for fiduciary responsibilities. For fiduciary responsibilities, trust responsibilities, you can't write that in a legal filing for why you're taking on all this uninsured bank deposit risk. You have to go seek out formally safer alternatives, even if you have the sort of, come on, it's a too big to fail bank, we're fine, kind of attitude. So as a result, there's sort of just an institutional legal compulsion to compel all sorts of institutional investors, your pension funds, your university endowment, bank trust department on behalf of rich clientele, so on and so forth. Sovereign wealth fund, where that's not going to hold water, and you have to come with some kind of alternatives. And the alternatives that the broader financial system has come up with, it's essentially a service industry, so it comes up with services as people need them and comes up with new products, has been essentially all forms of collateralized monies. So the idea being, okay, you don't have the protection of the FDIC, you don't, at least formally, have the protection of the Fed, but you can always sell the collateral, and that'll cover you even if it's defaulted. So, these are your repurchase agreements. The idea being that you hold as collateral that this treasury security or this other security potentially, and you also hold this liability, this obligation of someone else to buy the treasury back at a higher price, and they could default on that liability, and in which case you just keep the treasury and sell it yourself. There are all sorts of other kind of similar devices, shadow monies, quote unquote, that operate in a similar fashion, and that is it's essentially how all of that them usually work in our modern financial system. Um, is that there's this idea that is that, well, we have some collateralization that are backing these deposits, and it's fine. Um, and the that works until it doesn't. In 2008, 2007, 2008, we had essentially a shadow bank run where there was a drying up of liquidity, obviously also focused on private sector mortgage backed securities, ones that were rated AAA, and suddenly you didn't know how to price it. If you didn't know how to price it, what is its collateral value? What is its collateral price? And there was, a quote unquote run where people didn't want to keep on renewing, engaging in repo agreements around AAA securities, and suddenly trillions of dollars of what was seen as safe assets evaporated. Now, ultimately, those AAA mortgage-backed securities actually paid off. I read a post piece in 2020 about this. They sometimes confused between what happened with them versus what happened with what are called collateralized debt obligations, or the lower tranches of mortgage-backed securities. But anyway, regardless of what ultimately happened with AAA mortgage-backed securities, they were very difficult to value, meaning they didn't have good collateral prices, meaning that they were no longer the solid protection behind repo liabilities that they were seen to be. And the point is as you have these growing pools, institutional cash pools, financial net worth pools is the terminology I've used in my work. Um, you have these growing pools of money that need to have some cash balances. They need some safe part of their money to that they can grow when they're trying to sell out a position and shrink when they're trying to buy into another position. um, they can't rely on uninsured bank deposits, and what they can rely on, what's better, is fragile. They can also rely on short maturity treasury securities, but the government doesn't issue enough of them because they see them as a financing tool. They don't see them as a monetary policy tool. The Treasury doesn't. The Fed does, but the Treasury doesn't. That's like a constant conflict between treasuries and central banks, and so they don't issue enough of them. So that's not a solution to this lack of safe assets, this lack of essentially like what I've called in certain other work a shortage of large denomination money. In the 19th century, there were lots of problems with shortages of small denomination money. We kind of have the opposite problem. We have these big shortages of large denomination money, and the private sector tries to innovate, tries to synthetically create large denomination money, sort of like the private sector tried to make these small denomination monies alternatives way back when, and they both kind of have similar problems of fragility. Um, and so this latest crisis, what's interesting about this latest crisis is, as you're pointing out, um, there were a number of entities at Silicon Valley Bank which basically didn't have the kind of setup that these larger institutions have that make sure that treasury management happens, that there's fiduciary trust responsibility to make sure that you run your cash safely, especially also with like rich people who don't necessarily know about these kinds of things and don't hire a treasury manager. And people had literally billions of dollars in the bank. I think the top 10 balances was on average had 3.3 billion, which is a staggering amount of uninsured deposits, especially to have in a mid-sized regional bank.
Responsible treasury management would be you do some sort of sweep program where uh, they seeded out to all the other banks. So we're $250,000 here, 250,000 here, 250 there, and that way it's almost entirely insured.
Yeah.
And you also can put it into a money market account, which invests in repo. So you're limiting, if not entirely eliminating, the amount of money that you have in uninsured accounts. Needless to say, many depositors at Silicon Valley Bank did not do that. Sorry, back to you.
Yeah. Yeah, exactly. That's exactly the point. And um the and many, and so this has been a part of this conversation of, well, these people were simply irresponsible managing their money. They should lose it all, which of course, I'm not like so aggressively arguing the other side of that case. I understand why people who get lectures from tech CEOs all the time about their supposed irresponsibility, feels like people who have that sort of basic irresponsibility and are constantly lecturing others should eat some of their own medicine. Um, but part of the point that I was driving at, especially with this Posar piece, is there's a dark side to those sophisticated cash management tools. Um, in some ways, the thing that you were describing in terms of paying in one of these cash sweep programs to divide up an uninsured deposit into up to 600 insured deposits. That's kind of one of the more harmless ones, but it also shows the kind of silliness of the whole enterprise, where we have private sector actors who are collecting a fee to basically synthetically create deposit insurance greater than $250,000. And you could, skip the whole rigmarole by just having full deposit insurance. And then on the other side, with our increasing shadow bank runs, which have been happening more and more recurrently since 2008, and uh, and simply, um, the undesirability of having all these kind of activities that are getting financed outside of the financial system cause a financial crisis, which then the Fed steps in without having these activities brought into the regulatory umbrella. That kind of what's happening now, where we're having an escalation of, well, fears about uninsured deposits, um, show you know shows that the role that uninsured deposits are supposed to be playing, which is supposed to be disciplining banks. Hey, you do something wrong, we'll run away. That's not really working. And on the flip side, it's causing all these other problems which we want to deal with. And I wanted to bring that out and highlight that from Posar's original work, because for a while now he's been talking about our increasingly recurrent bank runs, just simply shadow bank runs, emerging from this mismatch between the deposit insurance limit and the needs of institutional investors.
Nathan, you think that in a world where we have these sweep programs where 250 here, 250 here, 250 here, that just creates a system where everything is insured, but companies are doing it and benefiting it. So why not, your argument goes, extend the FDIC, remove entirely the FDIC insurance cap?
Yeah, exactly. I mean, I think in practice there are probably limits to how feasible they can organize these cash sweep programs, especially with how concentrated the U.S. banking system is. That's literally a limit. How many banks can you get participating in the program? 600 times 250,000, I think, is like 500 million. So that's a limit. That's, you just have an operational limit from how many banks are in the United States of how large an uninsured deposit you can make into an insured deposit. And so that's very question begging for how that system is going to work. But the point of that kind of illustrates very sharply what I think is in general true about shadow banking: is the traditional theory that you have uninsured deposits forces uninsured depositors to engage in credit risk analysis, basically becoming private bank regulators, where they are keeping close watch on a bank's balance sheet to making sure they're acting prudentially. and then they will leave. The individual uninsured deposits will leave when they notice something, but it's not just going to only happen in one big moment of a bank run. Um, that vision, that dream, I think what I've called in certain places that utopian dream, I just think is not a reality. And I think that this cash sweep the insured cash sweep fintech solution uh, illustrates that as a sort of reductio ad absurdum. Credit analysis is hard. Banks don't even like engaging in credit analysis. They prefer relying on collateral worthiness rather than credit worthiness. But we're going to expect uninsured depositors who are going to engage in credit analysis of an entire complex bank's balance sheet. No, I mean, if we're focusing on incentives, and economists love to talk about incentives and how everything is driven incentive. The incentive you have as a large uninsured depositor an uninsured depositor is to turn to these shadow bank tools, whether it's cash sweep, whether it is repo, whether it is not even shadow money necessarily, just a certain form of money, treasury bills, whether it is money market mutual funds. Like they have this very very big incentive to just engage the shadow banking system and seek out collateral rather than do credit analysis in order to feel confident in their uninsured deposit. I mean, people have billion-dollar deposits that they're not doing credit analysis of. Like, where, is this something that we can realistically rely on? And I think the history we have is recurrently that is not the case. Recurrently, whether it's the savings and loan crisis, I mean, any, these crises, as Bill English, who's a former head of the monetary department at the Federal Reserve, monetary affairs department of the Federal Reserve, said market discipline doesn't work, and when it comes too sharply and too quickly. You're either having a bank run or you're not having a bank run, essentially. And in that circumstance, this reliance on what's called liability side discipline just doesn't work. So we need an alternative system, and full deposit insurance or full deposit guarantees is the first step to admitting to ourselves that we need an alternative system rather than pretending. And we can talk about how the actions of the Fed and their 13.3 program and the FDIC played a role in this kind of pretending thing.
Your argument is super convincing. Just people say, oh, restaurants shouldn't be regulated on a health code because if someone gets sick at a restaurant from food poisoning, they're going to leave a bad Yelp review, and then you'll get a 1-star rating, and no one will go to the restaurant. Like, I think you and I recognize that that's kind of a ridiculous argument, and that you need to be regulated. And I think the same way, if there's a boat salesperson, like has a company and they're selling boat, we want that person focusing on selling boats, not on doing credit analysis. And professional financial people make mistakes all the time. That it's if it's not your full-time job, it really should not be your job to do credit analysis. So I find that very convincing. Tell us about 13.3. Nathan, if folks are familiar with the work or if they've gotten the sense up until this interview so far, you are not a moral hazard kind of guy. All these bailouts are bad. You like using the power of the fiscal force to stimulate growth, prevent crises. That's just sort of your the way you look at the world. Yet, Nathan, you are paused at the Federal Reserve Bank Term Funding Program. And it raises a lot of questions about just the Federal Reserve's mandate and how it's constantly changing. What gives you such pause? Because I know you have a lot of thoughts about this.
Yeah. Well, what essentially gave me pause, and things have happened since then, which put this a little bit more into question than how it looked on the weekend. But nonetheless, I still think I kind of basically stick by it. Is this feels like it felt like a very regional niche issue, an issue that could have been handled with the discount window. And I was to take back, and we'll talk about the FDIC bit in a bit. There was a joint announcement Sunday night. There was the bank run on Thursday. Friday morning, the FDIC took over Silicon Valley Bank. over the weekend, whole debate about what the crisis response was going to be, or what the Fed response to this whole situation was going to be, what the FDIC's response was. The FDIC decided to use its systemic risk exemption to cover all uninsured deposits, and the Fed activated what's traditionally seen as its crisis powers, and we can talk about that a little bit. It's 13.3 unusual and exigent circumstances powers, to create the bank term funding program. And what essentially was that was it was just for charter bank institutions. It wasn't a wider program like a lot of 2007, 2008, and 2020 programs, which were essentially aimed at the shadow banking system. This is specifically was for the banking system. And what they did was say, uh, you can, we'll take in at our collateral window, we'll accept treasury securities at their face value. So that, if whatever their face value was, you can get a loan equivalent to their face value at this specified interest rate, from us, and up to a year maturity. And the reason why, and so one thing is, this is kind of amazing that they were using a crisis facility, which is traditionally associated with recessions and depressions at a time of elevated inflation. As we subsequently saw, and I think a lot of us thought would happen, there was an interest rate hike in the next meeting. It's very unusual to be activating 13.3 and be hiking interest rates at the same time. The unemployment is low. It's still low. Unemployment was low. It's still low. Inflation is still above target. And so it took people by surprise. And I, as a commentator on 13.3 and its use, I wrote this like 7-part series back in 2020. It was all about the different facilities that the Fed was launching, all the big and little ways that the Fed responded. And I knew a ton about 2007, 2008 crisis facilities that I could draw on that knowledge. This felt like something different. Like they're doing it for this regional bank situation. It's not the broader financial system. It's just the banking system, which, the discount window can and should be set up to manage. I was taken aback by their use of this tool, and it opens the question of what is this power? What does it mean? Is this like when emergency break glass power, or is it, as Powell said in the FOMC press conference that happened after, is it a tool that you use when you need, quote, a little more flexibility, which I felt was a totally shocking quote. Because if it's just a tool that used to need a little more flexibility, well, there's a lot of things that I think the Fed could use a little more flexibility on. For example, backing state and local governments, and backstopping them who've had gone through a lot of turmoil. There's still a lot of hospital systems that are badly understaffed and overworked and could use more resources, and you can tighten economic conditions more broadly without necessarily tightening it on the actors who are still in the front lines of dealing with, at the very least, with the aftermath, the fallout from COVID. So I'm taken aback by this and concerned about not so much the use of the powers, but the selective use. If it's something that you can use just anytime, then we need a much broader social conversation about what we think the Fed should be doing and what we think the Fed shouldn't be doing, and what kind of things that we think need to be supported and what kind of things we don't think need to be supported. Because as much as I'm a full deposit insurance, let's abandon liability side discipline type person, especially uninsured bank deposits as the liability side type person, that's not necessarily my first priority with the 13.3 facility if we're just doing it for anything and it's not specifically a crisis facility.
Right. So 2008, what the Fed did there, and 2020, what the Fed did with all the facilities, that was an expansion of its powers, unprecedented, something it didn't do before. However, it was a genuine crisis. In 2008, the financial world globally was on fire, and in 2020, you were having millions and millions of people being laid off pretty much every single day. So they broke the glass, but there was a reason to break the glass. This time, you're saying it was a regional bank crisis. There's not enough evidence that we're systemic, so you're a little taken aback.
Yeah, exactly. And yeah, I don't, and yeah, and then to comment also on the moral hazard thing. Yeah, I'm not a huge moral hazard person. Not to think that I don't think that you need accountability, but accountability needs to be on the asset side, regulation side. It needs to be due on taking financial institutions and what are they doing. What kind of how responsible they're being, and there are certain actors who I don't think that kind of framework applies to. State and local governments who are going to have falling tax revenues because of a recession, or because or have huge outlays because they're at the front lines of fighting COVID. I don't think there's any moral hazard involved in backstopping them in recessions or crises. Other institutions, there's more of a question. Obviously, too big to fail banks, that's a huge issue. But the only solution, you can't solve too big to fail by just letting the banks fail. You solve too big to fail by restructuring them, and restructuring them means restructuring their asset side activities. I mean, and we can talk about that a little more if you want, but I want to emphasize that it's not just sort of a kind of nihilistic vision. It's let's look at what works. Liability side regulation doesn't work, and we keep on running up against it not working. So we need to focus on the other side of the balance sheet in terms of
What would
regulation.
another side of another type of liability side thing that didn't work, and what's an example of an asset side regulation?
Well, I think a classic example of liability side regulation that didn't work is the savings and loan crisis. A lot of people attribute the saving loan crisis to deposit insurance, but many of the savings and loans involved didn't have access to deposit insurance. And even when they did, a lot of them were issuing bonds. I mean, the junk bonds got their start in the 1980s. A lot of them got their start in funding saving and loans. And there's no insurance on a bond. There's no insurance on a junk bond. There were people, some who were just little old ladies who were defrauded. Some who were more serious, larger institutional investors who still managed to lose money. That's a crisis where liability side regulation didn't work. I think Bill Black's book, "The Best Way to Rob a Bank is to Own One," is very illustrative of. Yeah, it's a great title.
Yeah.
It's a very illustrative of how liability side regulation didn't work, and the only way that they were able to crack down on the tremendous frauds that were happening was a regulator going against the grain and actually regulating when that wasn't the mood in the Reagan administration at the time. And that's actually where too big to fail start. And that's where this whole thing about uninsured deposits really got started. There was a bank called Continental Illinois. It was like the 14th largest bank. It was the largest bank in the Midwest. They were worried about their financial stability concerns. So the Fed and the FDIC again stepped in 39 years ago, 1984, to rescue that bank. And the FDIC covered all uninsured deposits. And obviously there was more with the savings and loan crisis that happened over the following years. Many people were very upset about this, about that. Continental Illinois is where the term "too big to fail" originally comes from. It's not from 2007, 2008. It's from Continental Illinois. And after many years of debate, we had the FDIC Improvement Act in 1991. And what was the FDIC Improvement Act? It wasn't, we're going to cover all deposits. They looked at that option and were really against it. That option, as I was just saying, requires a lot of asset side regulation, which was not the vibe of the Reagan, George H.W. Bush years. It means a lot of really actually being very restrictive on what banks can buy, what banks have, and the growth of bank balance sheets on the asset side. So they did the other option, the option that quote unquote protects the taxpayer. That poisonous term. Tries to avoid having all sorts of public money involved, And how they do it was to try to make uninsured deposits eat it as much as possible. You'd set up a bridge bank, you find someone other bank to buy, you only cover deposits when it's related to the franchise value of the bank, but ultimately you try to avoid having the FDIC have to shell out any money, and if it push comes to shove, having big write downs of uninsured deposits. Um, and that happened. And people took 50, 60% losses. Now, mostly small banks. As I said, this whole started off with Continental Illinois getting covered, and the big banks again were having difficulties in the late '80s, early '90s. They didn't fail. They again, like 2007, 2008, they were supposed to grow their way out of it rather than failing. But the mythology of uninsured deposits, of, well, having some little guys eat it from little banks, kind of papers over for the whole system. Hey, liability side regulation is working. It's not working. We just had a huge crisis, and a whole bunch of people took a whole bunch of losses, and then got the shadow banking system growing even more. That's a classic example where liability side regulation didn't work. And of course, in 2007, 2008, the largest banks, didn't officially have the too big to fail cover them. And there were a lot of people beyond uninsured depositors who were invested in those banks. Those banks had huge equity evaluations, many of them which hadn't recovered, even though they had a bailout. They had bondholders who could have potentially been made to eat it if regulators had made a little bit of a different decision. So recurrently, liability side regulation comes to have a lot of difficulties, a lot of troubles, and has not worked out. In the meantime, we've had huge growth in the financial system to go along with our recurrent failures around liability side regulation, and then the Fed stepping in a crisis. So that is that, and now we're back to where we started 39 years ago with Continental Illinois. And what I'm saying is, it's time to face up to reality and make the different choice. Go full deposit insurance, admit to ourselves that this system isn't working, and that we have to do something else to bring stability to the financial system. And it means having a difficult fight over asset side regulation, which of course I'm no illusions about that being an incredibly controversial and difficult thing to politically get through, but it's the only game in town from my point of view.
Right. And that brings up the issue of, if all bank deposits are going to be covered up to a certain limit, are bank deposits themselves collateralized by the fiscal agent of the government? I want to suspend that. I can ask you about that later, Nathan. But earlier you referenced just how strange it seemed to you that we had this Federal Reserve special facility enacted before a rate hike. Typically, these crisis, emergency, unnecessary, and exigent measures are enacted either when interest rates are at zero or when they're falling, or at the very least they've stopped hiking. But to have this crisis measure be rolled out and then have an interest rate hike, that's kind of unusual. I want to hear your thoughts on that. And then I know you also wrote a sort of long review of the monetary policy of the Federal Reserve, and you were particularly a critique of you were a critic of the rate hikes. So yeah, just share with us sort of your criticism of that policy.
Yeah. So, first thing we can touch on it a little bit is, the name of the show is Forward Guidance. So I feel like important to comment on forward guidance. The strangest thing about that Sunday announcement is that the Fed provided no forward guidance about what this meant for monetary policy, for interest rate policy. You could argue all sides of that, and many people did. Well, they're doing this intervention. They're worried about the banking system. Financial conditions have already tightened because we had this situation. They're clearly going to cut interest rates. You have the same worries, but they're not going to quite cut because they're worried about inflation. So they're going to have a pause. They're still worried about inflation. So they're, even with everything going on, they're going to raise a quarter. They're actually very worried about inflation. That we've had a hot print. The last print was a hot print. And so actually with everything going on, they're going to raise 50 basis points. There was no forward guidance about what that was going to be, and the interest rate decision was the Tuesday after next. It was 9 days later, 10 days later, if you know the official announcement coming Wednesday,
Mhm.
um, and that itself was a huge problem, which caused its own round of financial instability because treasury securities dealers, people operating in the treasury market, had no way to go to think about interest rates. You know, the Fed policy, both its current interest rate policy and expectations about its policy in the future, especially its near future, is what structures interest rates across the yield curve, and it's what it's the primary determination. It's they're not great at guessing, so it's not like actual you know trajectory of Fed funds predicts the interest rates that we get in treasury markets, but it's their expectations, and the expectations were just all over the place. It was a very uncertain moment, and as a result, spreads blew out, and we had a lot of stresses in the treasury market, like we did in March 2020, and as a lot of the discussion in March 2020 has talked about, there's a whole bunch of entities that have leveraged bets in Treasury futures markets, which rely on spreads in the Treasury market staying within certain limits. And so, as those spreads blow out, there's huge pressure on the leverage positions that a whole bunch of hedge funds and other financial sector actors are in, and causes broader financial treasury market stress on top of everything else. This is one way, you can look at that and say, see, 13.3, they should have done it because there were all this financial market stress that happened. On the other, but my point is, if they'd done proper forward guidance, they could have avoided those treasury market stresses altogether. And it also is just kind of highlights another sort of plumbing issue that's going on in the treasury market, which hasn't been kind of fully resolved, but in this case could have really been managed with proper forward guidance. And so I was hit a huge problem on that. And obviously we can talk about, like, well, then there's actually talking about its interest rate decisions, which we can take on next.
Right. So forward guidance is hinting to the market, telling the market what you're going to do. You had all this volatility in the treasury market that could have hurt some players if you had a bet on, oh, the spread between the 3-month treasury and the 1-month treasury, historical, 95% of the time it's never within this limit, and then it's goes out, spreads out 20 times that limit. I think now, like, the 1-month treasury is trading like 80 basis points below the equivalent sort of interest rate, whether it's Fed funds or the secured overnight financing rate, SOFR. Even though the treasury yield's going down and the rally has helped bank equity position via the held to maturity. So the whole if Silicon Valley Bank was still around, those losses would have been a lot better.
Yeah, I mean, that's the other piece, which I didn't really emphasize in that piece, but I was really, laughing to myself about, is for, the FDIC was, in charge of those banks at that time. And if they're going to hike, then sell out now, selling out position then, and you thought interest rates were going to keep on going up, unprecedentedly, then you sell out now to lock in your losses and not take more. But if you think that they're going to cut, and you think interest rates are going to, like, hold steady for a while, and you're going to get a reversal on long maturity interest rates, then you hold to get a gain, and maybe maybe there's no losses involved in these banks at all. Once because as I'm sure it's been covered in other places, and so listeners will definitely know. But just to reemphasize, everything that was going on with Silicon Valley Bank in terms of losses, rather than liquidity, but actual losses, was interest rate risk, and interest rates being far above their acquisition interest rate, and thus evaporating the actual value of the bonds, both their collateral value and their selling value. And the bank term funding program dealt with raising the collateral price. They essentially wiped away any losses on the collateral price, so that they wouldn't have any problem funding themselves, and they could fund themselves directly at the Fed if they needed to. But there's still the question of their actual price, and some of those losses have been reversed since since the crisis, because of the crisis, which is a kind of irony of it. Um, but potentially could go even further. And it's kind of funny to have one element of the government that has to make bets on what the other brand of government is going to do in terms of the losses that they're going to take. And you kind of look at it on each side. One is, well, it's insider trading if they do that. On the other hand, it's like, well, we're going to take losses just to take losses, just to keep up these walls between different parts of the administrative state. It's like both ends of that are kind of silly and ridiculous situation.
And so, Nathan, you talked about the bank term funding program. I just got a question, which is your critique of the Federal Reserve goes a lot deeper than other critiques, specifically of its interest rate policy. Some people say, "Oh, the Fed hasn't tightened enough, or they've tightened enough. They've tightened too much." Your critique is specifically about the idea that high interest rates fight inflation, and that low interest rates cause inflation. I'd love for you to share your sort of your critique of, I mean, the past hiking cycle of raising from 0% to 5%. You don't view that as a good thing at all. And a lot of people, especially in the mainstream financial sectors, say view Paul Volcker as, oh, thank God he saved the U.S. economy from inflation by hiking interest rates, above 15%, above 16% in 1980, 1981. I don't know your view, but my sense is maybe your view is a lot more critical. Just share your view.
Yeah, yeah. So there are two angles to this. One is there are potentially better tools to be doing to manage demand in more equitable ways, in ways that affects that harm the most vulnerable less. And there's still demand management, but they're demand management differently. One is, as I wrote a report on last year called "The New Monetary Policy," or put out last year. Was working on it for years beforehand. Came out in January 2022. That report is focusing on, let's not use interest rates. Let's instead use direct credit regulation. And that's sort of like, for me, there's kind of two birds, one stone with full deposit insurance and then direct credit regulation. It's, on one hand, you're dealing with these financial stability issues with the shadow banking system, and we're getting rid of the myth of that we can do things through liability side management, and also dealing with the inequalities that come with greatly growing the financial system relative to the rest of the economy. But on the flip side, it gives us a powerful tool to restrict demand in the economy. And you can tighten direct credit regulation rather than raising interest rates. And that serves two goals. One is, I think it's just a better tool for managing demand. It's both more effective and can be more targeted to particular sectors and particular areas. And it also keeps clear what we need to be managing, that what we need to be managing is inflation, that it isn't like we're worried about some government crises. And the thing about interest rates is that you raise interest rates, you have this projection of 6%, 7% money interest rates, and you could build some sort of forecast where debt to GDP, where government debt to GDP is growing to the moon, and saying, "Oh, we're going to inherently have a government crisis." And I don't think that's how it turns out in general. But political economy wise, being able to project, "Oh, we're going to have $1,000 trillion of interest payments over the next 70 years," is a huge barrier to using fiscal policy the way that I think it should be used. And so an alternative to that is low interest rates for government, specifically for government on government liabilities, but it's not, oh, we just have loose monetary policy forever, who cares about what's going on with monetary policy. It's using this alternative tool, direct credit regulation, to do that. And we can talk about, I think actually kind of the history of the Fed's monetary policy framework, which I wrote a piece on, kind of illustrates why this is potentially a very effective thing to do.
So yeah, what does that look like? How, if you keep interest rates at zero, how are you going to make it sure that you don't lend money in ways that are inflationary? Because lending creates inflation. There's supply side factors as well, but when you print money or lend money, which are pretty similar things actually. There's a too much money chasing too few goods. That's inflationary. So if you were to keep interest rates at zero in 2022, how would you curb lending, and then how would it be affected? And right now there are, needless to say, your framework, Nathan, what you just elaborated, goes against a lot of mainstream economic thinking about private markets, as private markets being the best allocator of credit. So if all these commercial credit card companies they're used to making loans, and they do follow a certain formula, commercial real estate lending, mortgage lending, auto lending, it's all in the private market. How would you sort of change that? Because that would be a huge change.
Yeah, and it would be a huge change. I'm not shying away from that. So, first I want to kind of emphasize something about the Fed's monetary policy operating framework, which I wrote a huge piece at. Is there's the operational target, there's the intermediate target, and then there's your longer term goals. In our current system, we have the operational target is short term interest rates. The intermediate target is financial conditions. You raise interest rates to try to tighten financial conditions, and then that is supposed to affect spending in the economy, and affecting spending is supposed to affect employment and inflation and so on. And what I kind of got into in this piece a few weeks ago is what's kind of funny about this structure is that's exactly the structure that we were using in the late 50s, in the early 60s, and under Bill Martin's Federal Reserve, who was Federal Reserve Chairman for 19 years, and from the Fed Treasury Accord, which gave the Fed discretion over interest rates, to through to the Nixon administration, we used that kind of framework. Now it was different. The people knew a lot less then. That was more kind of touch and go, based on sort of qualitative financial system knowledge. Bill Martin was head of the New York Stock Exchange in the late 30s. That's one of the big things he did in his career that eventually led him to be Fed chairman. And so, from the academic point of view, from the outside point of view, from the congressional point of view, this whole thing seemed like a black box. What is financial conditions? What is any of this stuff? What's feel of the market? And so there were a whole bunch of academic criticisms, including monetarist criticisms, because financial conditions focus isn't the money supply focus. And they were like, you got to change this. So over the years, there was different experimentations. There was, still using interest rates, the operational target. Then the money supply is an intermediate target, and all sorts of problems happened to that. Different changes that happened with the financial system that moved the money supply around. Interest rates aren't actually a great way to manage the money supply in general, or to try to manage it. Then there's also questions about whether the money supply actually is a relevant measure to demand, employment, and inflation. The kind of pinnacle of that is Volcker, who says he's no longer trying to even operationally control interest rates. He's trying to, control base money, and that's supposed to control the broader money supply measures, and that's supposed to control demand in the economy. I wrote a piece last fall saying that was, when you look at the FOMC minutes, behind closed doors, they were admitting that they weren't doing that. They might have been still trying to use the money supply as an intermediate target, but they were still controlling interest rates. They were just setting an interest rate band. It was just a larger band than the interest rate band that we have now, which is just a 25 basis points band. Mm-hmm. Then they had a 4% band, which is a huge band to have for overnight interest rates. And that led to a ton of interest rate volatility overall. They didn't do any forward guidance. The Volcker era was not an era that believed in forward guidance. The Volcker motto about financial market participants was you feed them shit and you leave them in the dark. That was Volcker's approach, and because he thought that the uncertainty of it was a boon to killing demand in the economy, and he might have been right about that, but it wasn't controlling the money supply. We get out of that era. The unions are crushed. Inflation is lower for various reasons, but Volcker plays his role. And Greenspan feels comfortable. Okay, we can safely announce interest rates targets, but doesn't really know what to do in intermediate targets, and no one really does. It's kind of like amazing, but there's not really kind of a strong idea of what the intermediate target is throughout the 90s and the mid
Intermediate
2000s,
target for rates, money supply, or
or
inflation,
for no
unemployment?
for anything. Just like
Yeah.
what were you doing with interest rates that you what so you knew you're announcing interest rates, you're announcing you're moving interest rates around, but what are you trying to affect that is supposed to affect demand in the economy? Obviously there's all sorts of things you could come up with. It could be broader interest rates in the economy. It could be the money supply still somehow, which there's still ongoing debates about in the Fed. But you kind of have to come up with something, and instead, the Greenspan era didn't really come up with anything. It came up with what I call the phrase I pulled from that time, constructive ambiguity, where we're giving you more information than Volcker was, but we're still kind of vague because we're not actually sure ourselves how this interest rate management thing is supposed to be working, how it's supposed to be managing the economy. And, fast forward through that, what essentially you get to is we're financial conditions. We're back to the financial conditions of the Martin era, except we know a lot better, more. We are much better at process. We have these regular FOMC meetings where we announce, but ultimately, and now we have these indices that, we have financial conditions indices, which you can point to. Everyone and their mother has a financial conditions index that you can go look at. If you look under the hood, those are kind of like a mishmash of all sorts of different things and kind of even conflicting concepts in them. But nonetheless, we manage financial conditions. And so we're back to sort of that idea of you operationally move interest rates around in order to affect financial conditions, in order to affect the broader economy. And this is sort of where you get back to direct credit regulation is, as Silicon Valley Bank illustrates, you can have things that move that tighten financial conditions that are an alternative to changing interest rates. I think even Powell said in the FOMC meeting that the tightening of financial conditions was like quote unquote equivalent to a 25 basis point hike. And then we can argue over how what equivalent interest rate hike there is, but even that whole idea that something can happen with financial conditions separately from the operational target that that is the equivalent of an interest rate hike illustrates that we can be doing something different. And so the idea of direct credit regulation is, you set certain minimum qualitative standards, and also you have quantity, you have very potentially, you don't necessarily have to do it this way, but I think it probably is important to do outright quantitative caps on how much credit that the banking system can originate in a given year. And you count credit lines against that, and I'm actually going to be writing more about this quite soon. But you move those things around. If you want to loosen financial conditions, you can raise the credit ceiling cap, the credit origination ceiling cap, how much credit the banking system create. And if you want to tighten it, you can lower that cap. And that is something that the FOMC can have control of, just like it can have control of the federal funds rate. And that is an alternative tool for tightening and loosening financial conditions. And that's a way where you can tighten and loosen financial conditions without changing interest rates. And yeah.
Is this something like what you're describing? Is it somewhat similar to window guidance?
It's somewhat similar to window guidance. The problem with window guidance is that window guidance is conditional. You have to be borrowing from the discount window in order to be under window guidance. I'm going to be writing about this a lot more in the future, and I might even be writing about some of it in my book, but definitely going to be writing it in the newsletter, that in my argumentation in the 50s and 60s in the US, we had a system of conditional direct credit regulation. So precisely as you're saying, window guidance, when you use monetary policy to try to squeeze banks to the discount window, and then at the discount window, they are under sort of pressure rules around direct rules around what kind of credit they're extending and how much. But there were all sorts of difficulties around that. Banks don't want to be squeezed to the discount window. And when you do it on a conditional basis, you're giving them scope to avoid. market-based forms of funding start growing out, and the more and more they try to seek out market-based funding rather than go to the discount window, there's a spread opens up between the discount rate and whether it's the federal funds rate or some other market interest rate, and that spread creates a lot of financial distress. And this is how the 1966 credit crisis happens, which Minsky calls the first episode of financial instability in the post World War II period. Is precisely around these kind of issues. A mini version of it happens again in 1970, and ultimately it's these kind of dynamics which make what the Fed was trying to do with Volcker become completely untenable, and is a big part of the reason why they abandoned it. That's a larger story. I'm going to have to write a lot more about that, so we're kind of getting ahead of what I've kind of put on the page. But yes, the that idea takes some of the same inspiration from that period, except not make it conditional. It's if you have a bank charter, you're subject to these kind of credit regulations, not just if you're at the discount window. Um, and and other countries had forms of direct credit regulation. I wouldn't necessarily you have to update it. And this is part of my report last year was doing, and we're going to do more work on that, on how to update it. You have to update it for the modern financial system. You have to update it for how you're going to have this whole system interact with the shadow banking system, which is a complicated question, which I think might be over the scope of this interview. Maybe I could come back and talk about it sometime.
Yeah, I'd love
But
that.
but the inspiration is definitely some. There's a good book called Controlling Credit by Eric Monet, who used to be at the Central Bank of France, and is now, I think, a professor at some department in France. And he illustrates not only how the French direct credit regulation system worked, but how most countries that weren't the U.S. or the U.K. had direct credit regulation systems in the 50s and 60s, and they, in a lot of ways, worked better. And that's a whole kind of other story that can be talked about. And Eric would be, I think, a great guest to have on, by the way. But yeah, that's yeah. The short answer to your question is yes.
Direct credit regulation would have to be tweaked, I imagine, to be for the era now we have, where we have an excess reserve regime and there is no reserve requirement. So right?
Well, so I specifically don't think you should rely on reserve requirements at all. I think it's a huge misstep of that system. Credit ceilings work directly on how much credit you can originate, regardless of the level of settlement balances in the banking system. I don't think you should use liquidity requirements at all for chartered banks. I think that you should do it all on the asset side. And if you want to tax the banking system, directly tax it. Don't indirectly tax it through liquidity regulations. So yeah, I think I credit ceilings operate directly on the asset side, and I only think that it should be asset side regulations, not quasi taxes or liquidity regulations. And I've been saying the term credit origination ceilings rather than credit ceilings, because in a modern world, you have to be careful with that because
You have to refinance debt. You're talking about new origination.
Yeah. So what I'm specifically getting at is, so if you had it like the old credit ceilings, it could be interpreted that you sell a loan and the credit you get basically credit against your credit ceiling when you sell a loan. What I'm saying is credit origination ceiling, regardless of whether you sell a loan, that's how much credit that you can issue in a year. And I kind of think both sides. I think, both that any loan a bank makes should be pledged at the discount window, and that the second piece of that is it should be capped in origination ceiling so that you can't kind of get away by selling assets or off balance sheet.
That makes sense. You can't say, "Oh, I only have $1 billion in mortgage loans," when you actually originated 100 billion and then sold 99 of it to some other bank that packaged it into another product. All right, Nathan. Yeah, this is beyond the scope because we've been running long, but I just want to How do you define modern monetary theory? I have my own definition. I imagine viewers have their own. What
a thing to end on. So I'll do mine kind of quickly. Can't be comprehensive because I think MMT is a whole kind of school of thought, interdisciplinary intellectual project that is kind of growing all the time. But what I would say the core idea, and especially the core idea for your audience to understand, is that MMT is focused on what why do any of these kind of monetary instruments have value in the first place? And MMT's answer is that they're acceptable in payment to the legal system, whether it's taxes, whether it's child support, whether it's fines and fees, whether it's any sort of court ordered monetary payment. The legal system says you got to pay up. It tells you some specific ways that you have to pay up, and that gives money value. And then it asks the question, okay, if money gets value this way, if this is how money gets value, it's through some obligation that you have to the legal system that money fulfills, then what can we do with money? What are the limits to what it can do? What are the limits to the way it can reorganize property? What are the ways it can reorganize capital assets in the economy, the physical assets that we use to produce things? And what are the limits to how much the money, the monetary system, can be used to mobilize resources for some public purpose? Obviously, we do with the military, we do it by buying tanks and buying all sorts of things that are contracted. You can also do, MMT is kind of focused on other things that you can do besides the military, focusing on, building, potentially building a public health system. They're not really, you can all depends on what your values are, but can be focused on kind of how the monetary system can be used to physically resource some sort of public project and some sort of collective endeavor, and focusing on in that context, what are the tools that we can use to manage demand, and whether they're kind of much broader than, say, interest rates and raising taxes or spending cuts. But that's the core of it, I would say. It's thinking through of all the knock-on implications of that, of the central claim that money has value because it's accepted back in payment by the legal system, both taxes and government proper and court-ordered monetary payments.
Right. So there's a claim that governments don't print money, central banks don't print money. It's commercial banks that print money. MMT is a challenge to that claim, and it's a claim that money has value because it can be used to pay obligations to the government. So going back, very traditional argument, just to give it a little flair, is that if the king is demanding payment in corn's going to have value because it's the only thing that can, money is that which cancels debt. And if whether you're being paid in tobacco or gold, whatever the government demands as a sort of honorary tribute, now known as taxes, that is what's going to have value.
Yes, and so in the MMT frame, then bank deposits have value because banks have been issued a bank charter, and a bank charter um, essentially uh, grants the franchises out the public ability to create money, and that's another kind of justification idea behind direct credit regulation in the banking system. Is we're not interfering in the private sector when we impose direct credit regulation on the banking system. We are instead setting public terms on what is inherently a public-private partnership and the use of public powers. So use of public powers should come with public responsibilities, which of course is different framing than a bank-centric framing where banks have like invented money and invented the monetary value of bank deposits separately from the legal system, and then the legal system has sort of just encroached itself on banks. So it's a kind of different story from that. And yeah, it's banks might create most of our money, might create most of our kind of M2, and might then in turn use their powers to backstop shadow monies, and thus have this superstructure built on top of them. But at its core, it's public law, it's public money, it's public power that is at the center, rather than it sort of just being the private sectors on top, and the public is scrounging around begging to have access to the money faucet.
Yes, and it's a framework highlights the public sector, and looking back in the 1800s, uh, there were banks, not a central bank, but the first bank, second bank in the United States, that had a monopoly on national banking charter. And if you were the bank in New Hampshire, you could only have one in New Hampshire, and if it would be against the law. So yeah, banks can do what the government allows. That being said, in the broader financial history, there are times where the government, aka a prince, would have to pay a much higher interest rate than merchants. But now we live in a society where the lowest form of credit risk, the most risk free asset, is government paper, and that's the reality that we live in now. Nathan, another principle of monetary theory that I frequently associate with is that government deficits, the amount of how much a government borrows more than it spends, or spends more than it borrows, a surplus, that in itself is kind of like a amoral, inert quality. What matters is inflation, which is a public scourge. So if you have the theory goes, oh my God, can you believe what this political party is doing? The deficits, they're turning the government credit rating into toilet paper. I can't believe this. The reality is, if the program causes inflation, then it's bad. If it doesn't, it's not bad. So if you have a government surplus and inflation's at 15%, you have a problem. Whereas if you have a government, on the other side, if you have a government deficit and there's 1% inflation, you don't have a problem. Is that fair?
Yeah, I definitely think it's a deficit, a public deficit or public surplus, a federal deficit or federal surplus is a tool like any other, and it's whether that tool is serving its purpose. So you can have a deficit of 3%, but if unemployment's at 10%, then probably your deficit's too small. On the other hand, you can have a surplus at 2%, but you can also have unemployment at 2%, and maybe you need to tighten on the fiscal side. On the other hand, you might tighten on the direct credit regulation side. So you can use different tools for different purposes. Larger conversation can be, how much of what's going on is because of shortages that are related to demand versus whether there are price increases happening without shortages. So they're happening for different reasons besides demand conditions. On the other hand, whether we're having supply chain disruptions, which would have created shortages regardless, and not having as big a deficit was just creating hardships. And I think we can all debate different sides of sort of that concrete empirical question. MMT people themselves can debate among themselves of those concrete empirical questions. Simply having the shared framework doesn't mean that you agree on every specific empirical point. I would say, from my perspective, I would say, given that we didn't have the public apparatus that we needed to in terms of proactively managing supply chains, the big deficits we ran were the second best policy, and not running big deficits would have been worse. But we definitely should build up a proactive system that can manage supply chains and govern markets in a way that we don't have big price increases when we need to mobilize resources to deal with a big problem, or at least not have the degree of price increases that we ended up having.
Final question for you about MMT, Nathan, is the current way of thinking about government borrowing is, let's see, tabs: tax and borrow and then spend. So the government has to receive money either by taxing it, removing it, taking it from citizens, or by borrowing it, taking it from citizens or other people, just but a different form of and then they spend it. But MMT has a different model, STAB, Stephanie Kaplan, spending, tax, and then borrow, that you spend the money first. I understand that as a framework, but isn't it technically true that based on the law, the Treasury has to tax and borrow first? Like the TGA, Treasury General Account, can't go negative. It has to get money from the Fed, right?
So I wrote this piece in 2020. I think it's called something like the federal government always money finances its spending, a restatement. I'm sure you can put a link to that piece. And so for me, what the critical issue is, that the Fed argument, the MMT argument, as Stephanie Kelton both put it in her book, as you're referencing, STAB versus TABS, and also in the original papers that she wrote way back when, or in the late 90s already, almost 25 years ago now. and which I think really held up despite all the criticisms, all everything thrown at it, is it's focused on the federal government, not one specific agency, whether it's the Fed or the Treasury or another. And the key to understanding that is, especially with the arrangements that happened at the time, um, yes, the Treasury itself has, financing tools. We can say, we can mention just a small print. Since 1996, it's had the power to mint a platinum coin. But putting that aside, you can fill up the Treasury general account. You need taxes or issuing bonds, or you need the FDIC to have one of its banks borrow at the discount window, $150 billion, and that will fill up the TGA as well. So it's important to remember that there's a difference between restrictions on the Treasury directly borrowing from the Fed and the rest of the federal government directly borrowing from the Fed. But yes, ultimately, it regularly relies on issuing securities in order to fill up the Treasury general account. But from the consolidated point of view, every time that a payment goes out, it's marked down for the Treasury general account. What's happening in the broader perspective is that the money supply is increasing. Payment comes out from the federal government, goes into a account with a bank, which then in turn potentially runs into the account of a non-bank, of your proverbial grandmother on Social Security, and that is increasing the money supply. That is money financing of government spending. And then after the fact, a bond is sold. A bond is sold from the Fed. So what was happening originally is the Fed sold a bond. The Fed bought a bond to get settlement balances into the banking system to make sure that the Treasury auction would succeed. Then the Treasury auction happens, and payment starts flowing out, and the Fed resells a bond or engages in reverse repo, whatever, to drain settlement balances out of the banking system. And so, from a consolidated perspective, STAB is what operationally happens. The spending flows out, and taxes and borrowing come in, and taxes and securities issuance come in at the back end. And that's what happens when you have the fully consolidated perspective. It's kind of difficult to think about because we're not used to thinking about the federal government, including the Fed, being consolidated altogether and what that balance sheet looks like. But that's the core argument. Now, if in excess settlement balances regime, what happens is that the Fed, pre-primed the banking system filled up the banking system with settlement balances, so the Fed can issue
quantitative easing.
Yes.
Or, yeah.
And first with the emergency programs and then with quantitative easing, their banking system was filled with settlement balances. But in a broader perspective, they filled up the banking system first, and then some were drawn out. There's always that money financing of spending going on. There's just securities issuance on the back end. And, as I've made a proposal to kind of clarify this. To clarify what I think already works at the federal government level, change the Fed and the Treasury at this lower level to make everyone understand this federal government point, which is to have the Treasury directly money finance itself rather than indirectly or covertly have money finance through the Fed creating liquidity in Treasury markets, and have just the Federal Reserve Board issue securities, and the Treasury, whether it's minting the coin, issuing its own digital currency, or simply just having the power to directly create settlement balances itself, that are its own liability, that it have direct money finance, so everyone's on the same page about government monetary finance, and have the Fed, if it thinks for monetary policy purposes, it wants securities out there, it wants a certain kind of duration of government liabilities, it can do that themselves, and the Fed can take responsibility for that part itself.
Right. And the Federal Reserve, when it does quantitative easing, it buys it from primary dealers, and then primary dealers buy it from the treasury. So there's a layer of intermediation. You're just trying
Yeah.
to sort of cut through the BS and say, hey,
Yeah,
let's
cut
call a
through the
spade a spade.
noise, simplify it. Rather than takes 20-minute explanation, everyone goes, "Oh, of course, that's how it works." And I'm trying to reform how things work to reform myself out of a job.
There we go. Well, Nathan, your excellent blog, people should check out, is notes on the crises, plural. And a lot of the articles on there are for free, so people should just check them out while they still are free. Of course, as people can see on Twitter, you are at Nathan Tankus. The name of your book, which is in its early stages, is Picking Losers. Is that correct? And why did you
Yes.
call it that?
It's about the Federal Reserve. It's about the myth that the Federal Reserve can avoid picking winners and losers, whether it's with interest rate policy or with its crisis facilities, and the reality that it's been picking winners and losers from the moment the Fed Treasury Accord happened. And to move forward, we need to face the myths, face the reality, and make decisions based on that reality of picking winners and losers, and always doing it.
Excellent. Well, I look forward to reading that. We'll include some links to your articles and posts in the description. Nathan, thanks so much for sharing your ideas and insights, and thank you everyone for watching.
Yeah, glad to be here.
And thank you, Zoltan, for being in the background. Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.